What if I told you that every single year, ordinary Americans hide nearly $700 billion from the federal government? That's not a rounding error. 700 billion. And the most shocking part? Most of it disappears right in front of our eyes. I'm your stickman detective, and today we're cracking open the files on 7 of the most common tax evasion schemes operating across the United States right now. Some are painfully simple. Some require corporate lawyers and offshore accountants. Others are so widespread, you've probably witnessed them without even realizing it. The tax code is a maze, but the goal is always exactly the same. Keep money out of the government's hands. I've got the evidence pinned to my board, the numbers don't lie, and the trail leads straight to the people who think they're smarter than the rules. So grab your coat, sharpen your pencils, and pay close attention. Because once you see how the system gets cheated, you'll never look at a simple cash transaction the same way again. Let's get to work. Before we dive into the schemes themselves, we need to draw a very clear line in the sand. There is a massive difference between tax avoidance and tax evasion, and confusing the two will cost you everything you own. Tax avoidance is completely legal. It's what smart accountants do when they maximize your deductions, claim every credit you qualify for, and structure your investments to legally keep more of your hard-earned money. The IRS actually expects you to do this. Tax evasion, on the other hand, is a serious federal felony. We're talking about intentionally hiding income, fabricating business expenses, or outright lying on your returns to pay less than you legally owe. That carries up to 5 years in federal prison under Section 7201 of the Internal Revenue Code, plus financial penalties that can swallow 75% of what you tried to hide. So why do so many still take the risk? Because the immediate savings feel enormous, and the core logic is brutally simple. The government can only tax what it actually sees. If you successfully keep your money off the official books, the IRS has absolutely nothing to collect. That single dangerous idea is the foundation of every scheme we're about to unpack. It's not about clever loopholes. It's about deliberate deception. And it's happening right now in local cash registers, underground payroll systems, and high-rise corporate offices across the country. The line between legal planning and criminal fraud is incredibly thin, but it's a line that once crossed changes your life forever. Let's follow the money and see exactly how it disappears. Here is the exact number that should make every honest taxpayer furious: $688 billion. That is the official IRS estimate for how much money vanishes from the federal treasury every single year due to unpaid taxes. They call it the tax gap, and it has been steadily growing for decades. To put that staggering figure into perspective, it's roughly equivalent to the entire annual budget of the Department of Defense. Now, who exactly is hiding all this money? It's not just small cash businesses operating on the fringes, although they certainly play a part. Independent economic research consistently shows that the highest-earning 1% of Americans accounts for a massively disproportionate share of all unpaid taxes. Why? Because the complexity and scale of the schemes usually expand directly with the wealth of the person running them. Billion-dollar structures require billion-dollar cover-ups. But today, we're going to start at the street level and work our way up to the boardrooms. Because the most widespread foundational form of tax evasion isn't some glamorous offshore Cayman Islands trust or a complex international loophole. It's brutally simple. It's physical cash. It's transactions that never touch a bank, invoices that never get printed, and income that simply never gets reported. Once you understand how the smallest leaks drain the system, the larger schemes will start to make perfect, terrifying sense. Let's pull back the curtain and watch the numbers fall. All right, let's talk about the oldest, most reliable trick in the American tax evasion playbook: physical cash. If money never touches a regulated bank account, if there's no digital invoice, no credit card receipt, and no paper trail whatsoever, the IRS faces an almost impossible uphill battle to track it down. This method thrives in cash-heavy industries that still dominate Main Street. Think about local restaurants, food trucks, nail salons, landscaping crews, independent contractors, and home cleaning services. Here's the exact mechanism. A customer hands over a $20 bill. The business owner immediately splits that payment in two. A portion goes into the official register, gets recorded in the legitimate accounting software, and eventually shows up on a tax return. The rest vanishes into a shoebox, a personal envelope, or a hidden safe that never interacts with the government. You might assume these amounts are trivial, maybe a few $100 here and there. You'd be dead wrong. The IRS estimates that unreported cash income alone accounts for hundreds of billions in the annual tax gap, and it's absolutely not limited to small storefronts. Freelancers who accept direct cash payments and never generate invoices, landlords who collect monthly rent in envelopes, and independent tradesmen who operate entirely off the grid. It all compounds into a massive underground economy. The IRS knows this happens constantly, so they don't rely on voluntary compliance. They deploy indirect verification methods. Auditors will meticulously compare your declared income against your actual lifestyle. Do you drive a brand new luxury truck while reporting poverty-level wages? Do you vacation in Europe while claiming you can barely afford groceries? When those numbers violently mismatch, you instantly become a high-priority target. Then there's the Bank Secrecy Act. Any single cash deposit exceeding $10,000 must automatically trigger a currency transaction report to federal authorities. So, people get dangerously clever. They deliberately split large sums into multiple smaller deposits, carefully staying just under the reporting threshold. That practice is called structuring, and here's the critical warning. Structuring is a completely separate federal felony, even if the money itself was legally earned. The moment you intentionally manipulate deposit amounts to avoid detection, you've committed a crime that carries its own severe prison sentence. The system is designed to catch patterns, and cash always leaves a shadow. Now we enter a zone where things get legally murky, financially damaging, and honestly, deeply unfair to the average American worker. Picture this. Two people sitting at adjacent desks, performing the exact identical duties, working identical hours, answering to the exact same manager. One of them is officially classified as a W-2 employee. The employer automatically withholds their income taxes, pays half of their Social Security and Medicare contributions, provides legally mandated health insurance, funds unemployment coverage, and guarantees minimum wage protections. The other person is magically classified as a 1099 independent contractor. They receive zero benefits, zero protections, and zero employer tax contributions. Instead, they are forced to pay the full 15.3% self-employment tax out of their own pocket. If they get injured, they get nothing. If the work dries up, they get zero unemployment. Now here is the part that should genuinely anger you. In countless cases, those two workers are legally and factually identical. The only difference is the label the employer slapped on their paperwork. When a company dictates your exact schedule, supplies your equipment, demands your exclusive loyalty, and micromanages your daily output, you are legally an employee. Slapping a contractor title on your contract does not magically erase that reality. The IRS calls this deliberate misclassification, and it's a multi-billion-dollar scheme that shifts the employer's tax burden directly onto vulnerable workers. The government loses tens of billions annually in unpaid payroll taxes, while workers unknowingly sacrifice their long-term financial security for short-term convenience. The IRS and the Department of Labor use strict multi-factor tests to determine true employment status, focusing heavily on behavioral control, financial dependence, and the nature of the working relationship. If the facts point to employment, the law will ignore the label. But enforcement remains an uphill battle, especially in the rapidly expanding gig economy and staffing agency sector. Millions of workers sign these agreements every year, completely unaware they're being used as human shields against corporate tax liability. It's legal on paper but factually fraudulent, and it's bleeding the system dry. Now we shift from the street-level cash operations into the corporate boardroom, where tax evasion becomes a game of artificial geometry. Business splitting is a deliberate strategy where a single, highly profitable operation is artificially fractured into multiple separate legal entities. We're talking multiple LLCs, multiple S corporations, multiple shell partnerships, all created for one singular purpose: to keep each individual entity safely below critical IRS thresholds that would otherwise trigger significantly higher tax rates or disqualify lucrative deductions. Take the qualified business income deduction as a prime example. It allows pass-through business owners to legally deduct up to 20% of their eligible income, but that benefit phases out once your taxable income crosses specific limits. So, what do aggressive operators do? They simply slice their revenue stream into smaller pieces. Each fragmented entity reports just enough income to stay comfortably under the phase-out threshold, claiming the full 20% deduction repeatedly. When you reassemble the pieces, you're looking at a massive enterprise that should have paid millions in taxes, but instead is legally bleeding the government dry through artificial fragmentation. The IRS is well aware of this geometric trickery. They don't just look at the paperwork, they look at the operational reality. If Entity A and Entity B share the same physical address, employ the same staff, service the exact same client list, answer to the same controlling owner, and lack any legitimate independent business purpose, the IRS will immediately pierce the corporate veil. They will consolidate all the fragmented entities back into a single taxable unit, recalculate the true liability, and slap on heavy negligence penalties and back interest charges. Courts have consistently ruled that entities lacking genuine economic substance exist only to manipulate the tax code, and the law will not protect paper companies designed to deceive. This isn't clever accounting. It's structural fraud disguised as corporate expansion, and the financial reckoning, when it finally arrives, is usually catastrophic. Let's bring this entire investigation home. We've systematically uncovered 7 distinct methods used across America to illegally withhold taxes from the federal government. We started with the simple, street-level cash envelope, moved through underground payroll fraud and deliberate worker misclassification, climbed into corporate entity splitting, and finally arrived at the high-altitude world of shell companies, nominee directors, and sophisticated offshore tax havens. The techniques vary wildly in complexity and scale, but the underlying motive never changes: intentionally pay less than the law explicitly requires. Now, here is the uncomfortable reality that most people conveniently ignore. Tax evasion is absolutely not a victimless crime. Every single dollar hidden from the IRS is a dollar that honest, compliant taxpayers must ultimately cover. It forces higher effective rates for the working class, drains critical funding from public infrastructure, and actively rewards cunning deception over lawful compliance. The government is actively fighting back with increasingly powerful, modernized tools. The Foreign Account Tax Compliance Act forced global banks to open their vaults to American auditors. The Corporate Transparency Act now demands real, verifiable, beneficial ownership reporting. Audit funding has surged dramatically. Advanced artificial intelligence cross-references millions of returns for hidden mathematical anomalies. And the whistleblower program pays massive financial rewards to corporate insiders who expose the truth. It's a relentless, high-stakes game of cat and mouse. But financial history proves one undeniable fact: the mouse always leaves a paper trail. The penalties for federal tax evasion are brutally final and completely unforgiving. We're talking up to 5 years in a federal prison facility, massive fines reaching $250,000 per criminal count, and you still owe every single cent of the original unpaid tax debt, plus a 75% civil fraud penalty, plus compounding interest that grows while you sit behind bars. That is an astronomically expensive shortcut to absolute ruin. Our detective has reviewed the evidence, connected the strings, and mapped the entire underground economy. The conclusion is stark, unambiguous, and completely final. The system is watching, the digital net is closing, and the forensic math never lies. Pay your fair share, follow the established law, and sleep peacefully at night. Because in the end, the only thing you'll successfully hide from is a prison cell door.